There are a lot of varying opinions and methods out there right now about how the market moves around. There's things such as the Wyckoff method, Elliott wave, SBT, Stacey Burke trading, BTMM, Steve Mauro, beat the market maker. And one thing that all of these methods have in common is that the market moves in 3 pushes. Ladies and gentlemen, I'm going to not only give you a bunch of different variations in this video about how the market moves around in 3 pushes, but why and how to actually use that 3 push method to enter trades, identify trading setups, and overall just make your trading career more profitable. So real quick, do me a favor, hit that like button, subscribe to the channel if you haven't already, and enjoy the rest of the video. Like I said in the intro, there's multiple people throughout time that have identified that the market moves in 3s, such as Elliott wave, the Wyckoff method, BTMM, and Stacey Burke trading. Now, of course, some of these are older. These are before I was even born. Wyckoff and Elliott wave. Here's some examples of those, and something that you can see that's fairly similar is that you have a 3 push pattern within both of these. My problem with these is that they're not reproducible or replicatable, in my opinion. I could not formulate and figure out how to trade these on a day-to-day basis, whereas with Stacey Burke's method or style of trading, he puts it in a way that you can trade it every single day. You can find setups every single day, scalping in and out of the market, and basically finding setups where you're just taking 1 or 2 trades in a day and being done, or maybe even 1 or 2 trades within the week. I enjoy that methodology and that style much more, and I found that it was a lot easier to reproduce compared to looking for all of these different rules and all of these different points in the chart that are important for you to make decisions. However, something that all of them do have in common is that they all work in 3s, whether it's Elliott, Wyckoff, BTMM, Steve, he talks about 3 levels. They all move in 3s. If you would like this slideshow to download it, it is free. The link is in the description of this video down below. You can download it, save it as a PDF, do whatever you would like with it. And within the PDF is going to be all of these links that will take you directly to the charts that I will be referencing throughout this video. These are some 3 push considerations, some things that you need to take into consideration before even going further in this video. The market is always moving in 3s. Whether you know it or not, it's moving inside of a consolidation of some kind, and it is working in some sort of 3 push pattern. The market is fractal. Everything that is happening on a higher time frame is happening far more frequently on the lower time frames. If there's an uptrend on a 15-minute chart, but the 15-minute chart is currently pulling back, you might be in a downtrend on a lower time frame. You might be in an uptrend on the monthly chart, but a downtrend on the 15-minute chart. You have to be aware and understand that people are trading on all these different time frames, and that's where we start to use the monthly, the weekly, and the daily, previous days highs or previous days lows, or just the previous highs and previous lows levels for understandings of where people are getting into the market. We call that other time frame traders, and that is to help us identify liquidity areas. Basically, once those other time frame traders are in the market, where are their stops? Where is the money at on the other end of that range? 3 pushes ends a move. On that 3rd level, they will usually blow off in that direction on that 3rd level and then go into consolidation. This is a trap, a way of trapping people on the 3rd level before reversing the market and going back the other way. 3 is a psychological number. If the market has moved twice in a direction, it has to keep going that direction. And it may for that 3rd push, but it might not go as far as you expect. And that is the trap. That is the psychology of how the market moves, because if that 2nd push, people believe it's going to continue and everybody jumps in, it makes it very easy for the market maker to understand where people are getting in and where they are putting their stop loss, so that way the market can continue its search for the money. One more definition that you really need to understand is simply consolidation. Everything between a high and a low is consolidation. And think about what I just said. A 1-minute candlestick creates a high, it creates a low, it has an open and a close. That means that in between that high and that low, when the next candlestick forms, it is in consolidation until it goes to the outside of that 1-minute bar. If I take that same idea and I apply it to a weekly chart or a monthly chart where one candlestick equals 1 week or 1 month, Everything on the inside of that candle will now become consolidation. This is a weekly chart. Each candlestick represents 1 week. And you can see the first push, the second, and they ran it up into a 1, 2, 3 to end the move. And if you're looking at this chart over here on the right, this is a 15-minute chart of the same exact, this is the exact same chart, okay? I've just changed the time frame. And I've highlighted this area of the chart up here, right here. This is the previous week's high. Notice how they come through the previous week's high on that third level or that third push coming out of on the weekly chart. So now we're in the third level of the weekly chart, 1, 2, 3. We're up high. And they've done a 1, 2, 3 outside of consolidation. This is the previous week's high, and we've came out of that consolidation in a 1, 2, 3 and gone sideways. Monday, Tuesday, Wednesday. On Wednesday, there was a strong capitulating move to the downside out of level 3. And that is where some of the larger moves can happen. All right, that's why we use these higher time frame levels. Previous week, previous month, previous day. We use those levels because we know that other time frame traders are in the market. 3 pushes will create some kind of trap. On that third push, they will create some kind of sideways maneuver or some sideways movement. Usually it's very choppy in that third level because it's an accumulation pattern. It's an accumulation phase of the market. That third level will get people trading in both directions and then shift in the intended direction, which you can see right here. Real quick, I don't want to take too much of your time. Down in the comments below, let me know what you think of the video. Maybe you have some questions, or at the very least, comment something like, I don't know, nice shirt or mustache. Appreciate y'all. Now, I know that this is all just identifying and characteristic style of information. If you stick around all the way to the end, I'm going to give you ways to use it with rules. All right, I've made it very rules-based. My entry criteria is rules-based, and I'm going to show you exactly, step-by-step, how to use this to get into the market. But for now, you need all of this information so that you can be aware of all the things that go into that criteria. 3 push variations. These are the different scenarios and different variations of a 3 push pattern. 3 levels, also referred to as stair-stepping. 3 pushes. These are all the different variations that I have found of a 3 push pattern. Stair-stepping, 1, 2, pause 3, 1, 2, 3, 1, pause 2, pause 3. A 3 burst impulse. We also have 3 pushes out of consolidation, and that can be any one of these 3 push patterns. Or also working a level in 3 pushes. You basically have created a high or a low, and you've just hit that same level 3 times, creating a triple top or a triple bottom. And all of these patterns can be observed on any time frame. Like I said in the beginning, markets are fractal. All of these things are happening all the time. Now, this is where the magic starts to happen. I've got lots of pictures. I've got lots of examples. So let's get into the first example. 3 levels. Starting off with 3 levels. I've thrown in a few different variations of just 3 levels on different time frames. Let's look at it throughout the entire week. We have an opening range, the high and the low of Monday. Looking for 3 push patterns outside of the opening range. 1 push, 2, and 3 outside of the opening range. They've stair-stepped it down into the low of the week, gone into consolidation on that third push, and reversed very aggressively. That is a trade setup for me that I look for on a weekly basis. 3 pushes out of the opening range. Something else I would like to add is that something that I do very objectively is I use the previous day's level to help me identify 3 pushes out of the opening range, specifically for the opening range. Okay, whenever I have 3 pushes out of the opening range, I use the previous day's, for example, low to help me identify where the next push has occurred. If we have this push right here, I need price to go down further than that to tell me that that was a push. It doesn't necessarily have to close below it, but I definitely want to see them jam down through it. Now, although I do have this previous month's high up here on the screen, you can use this for any sort of major level, such as previous day, week, month, year. This works for all of those levels. If you're watching this and you see that they have came out in 1 drive, 2 drives, 3 drives, and gone into consolidation, you can start to develop a thesis about, oh, there's been 3 levels out of a consolidation of a major level. If you get a signal day, you can start to add things in, such as first red day, we're up high, we're in the 3rd level, we've had a failed breakout at the high of the current week. oh, maybe this is a more high quality setup, and I can take that trade on the next day. But just to reiterate, previous month's high, consolidation. We've came out of consolidation in one push, a second push, and a third push, and obviously the capitulating move that followed. This is a very common pattern. Stair-stepping in three pushes. A lot of times you'll see this after you get breaks in structure or even of structure where they've made a new extreme and they have to pull back. So from this, you can see that we have breakout, pullback, push 1, push 2, push 3. They've stair-stepped it down in 3 pushes. Whatever time of day this was, this looks like it was around New York, the New York time frame. 8 a.m. Eastern time, 9:30. They have gone vertical to continue that long trend after you get your 3-push stair-step down, and they've gone back up. Here's an example of a level being worked in 3 pushes. Again, a very common pattern. This is a 15-minute chart where they've actually broke structure to the upside. They've created a low. They've came back down and retested it once, twice, 3 times. 9:30 open, engulfment to go back up through the high and do a range expansion of this lower rectangle up through the high. Another variation being the 1, 2, pause 3, or sometimes you'll see it as a 1, pause 2, 3. Multiple different variations of pretty much the exact same theme, 3 pushes. So 1, pause 2, 3. We have a move up. They basically broke structure to the upside. They are continuing a trend, but they have to pull back after they make a new extreme. They start to come down. 1 push down, pause, 2, 3, engulfment, continue that move. Here's pretty much the same exact example, except this is a 1, pause, 2, pause, 3, and then it continues that move up. Here's a very common example that you'll see all over the chart, usually into an extreme or to end a move in general. 3 pushes, just a 1, 2, 3. 1 candle, 2 candle, 3 candle, engulfment. 1, 2, 3, engulf. Okay. Sometimes it'll come as a 1, 2, 3, down, up, down, engulf. Regardless, 1, 2, 3 ends a move, goes into consolidation, and reverses. Here's another very common one that I think that most people don't even know to look for. 3 impulse pushes. And this comes in all kinds of variations, but once you start to notice certain behavioral characteristics of the candles, and you notice that the market is always trying to get people to do something, you can benefit from that if you catch it in time. For example, I've got some candles marked off here. Look at the size of all of these candles relative to that candle, that candle, that candle. Smaller candles, big candle. Smaller candles, big candle. Smaller candles, big candle. Consolidation, reversal. Impulse 1, 2, 3. Push 1, push 2, push 3. Consolidation, reversal. This 3-push pattern is a 1, pause, 2, pause, 3. 1, pause, 2, pause, 3. And a lot of people are probably going to ask me, what is a pause? It's simply just a candle that has opened, gone sideways. There was no significant amount of movement. You can tell that that candle is smaller than all of these other larger candles. And then they continued the move on the next candle. So if you're watching this pattern form and you're like, well, I don't know what kind of 3-push pattern it is. There's only 2 candles, whatever. You're just waiting. You're just waiting to see which one of the 3-push variations forms. In this case, it was that 1, pause, 2, pause, 3. Now that you have all of the information, you basically have the keys to the kingdom. All you have to do is get really, really great at identifying not only the pushes, but the larger setups. This is how I break down information in my brain and start to compartmentalize, categorize, and sort information on the chart. Break things down. You have to break it down. You have to start big and go down from there. And I'm not saying start on the yearly chart and start marking off every support and resistance line there is. No. I use the 15-minute chart and the 1-minute chart, and that is it. But I have to identify a larger setup on that 15-minute chart. I have to find a first red day, first green day, inside days, weekly template trades, something along those lines. I have to find that first, number 1. And then I start to break down structure. Have we had a break in structure or of structure? Those things are very important, number 1. Number 2, I need to let the market give me supporting information. I need the market to prove to me that my thesis or my setup is valid. And I'm just waiting. I'm just waiting to see if it proves it to me. I'm using the time, those previous levels that I've talked about earlier on in the slideshow, and I'm using price action to determine if the market has proved to me that I'm right. And finally, the thing that seems to be the most confusing, but also the simplest to use at the same time, is my entry criteria. It's a list. It's a checklist of things that I need to see before I get into the market. I need a high formed or a low. Basically, I just need a level formed. I need to trade back into that high or that low in a 3-push variation. The entire slideshow that I've created, the entire video that I'm talking about is about 3-push variations. So I need one of those to trade back into a level. I need a break of or in structure. I need a break in structure, and I need a chart pattern, M's, W's, triple tops, triple bottoms, head and shoulders, inverse head and shoulders on the 1-minute chart to show me that that trade is valid. It's about to potentially take off in my direction. I'm just waiting for one last step. I need an engulfing candlestick. I need them to engulf my chart pattern on the 1-minute chart so that I can get in. Here is a 15-minute chart. I'm going to walk you through this entire criteria 1, 2, and 3 right now. Here's a 15-minute chart of the British pound US dollar. This is the opening range. Monday's high, Monday's low. We have 3 pushes down out of the opening range. Step 1, I'm identifying a larger trade setup. On top of that, we have a dump day, a Thursday that's traded down below the previous day's low and then closed back up above the opening price. Now, in this case, it pretty much closed exactly level with the opening price, but that's okay. It's the behavior and the fact that it was really just like 1 or 2 pips off. I'm not going to be a stickler about that. This is a first green day. I have 2 setups now in unison that could be about to play out. The direction is exactly the same. I just need to see and look to see if the market proves to me that it's going to play out. Now, let's look at some supporting information. Price, structure. We had a higher high form. We had a low, a high, a lower low. Boom, they've made a higher high. They broke structure to the upside. After I have a break in structure to the upside, I need 3 pushes down. What this entire video is about. I have to identify that. They've came down in that 3-push stair-stepping motion. I've identified it. Fantastic. We're about to come into the New York session. Time. New York session. 9:30. 8:30. Time of day is very important. Price action. We've gone into consolidation at the low of the current day. Good enough for me. Let's keep going. Entry criteria. This is the 1-minute chart for that chart that we were just looking at on the 15. There was a established high and an established low on the 1-minute chart. They made a lower low first, and then boom, 8:30. Major red news. They spike and they break structure to the upside. This is the first time they've made a higher high. Once that happens on the 1-minute chart, I need 3 pushes back down. Since we've made a higher high, I need them to come back down and prove to me that they're willing to make a higher low for me to continue that trade. They've came down 1 push, impulse candle. 2 push. 3 push, down, up, down, chart pattern. W, double bottom. Then I need an engulfing candlestick. There it is right there. That's going to be my entry every single time on every single kind of trade. The criteria remains the same. The candlesticks will just look slightly different. The 3 push patterns will look slightly different. The way that the trade presents will present slightly different every time. Other supporting information, we have a major price level, bank level, double zeros right here. We're at the bottom of a 100 pip box. That is it. I just take a large scale setup that I have already defined in previous videos. And if you're interested in those, they're in the playlists on my channel. Feel free to go back and watch those. I take a large scale setup and I start to break it down into supporting information. And I let the market prove to me with that supporting information that my thesis might be correct. I use things like the 3 push pattern, which is what this entire video has been about, to help me develop a thesis and to help me develop an idea about where to get into the market and when to get into the market so that I can make more accurate trade decisions. That being said, ladies and gentlemen, if you've enjoyed this video, do me a favor, hit that like button, subscribe to the channel if you have not already. You'll have a wonderful day.